Live from the City of London for our audience worldwide. How about that data? Equity futures up by 0.6% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Ferro.
Coming up, falling jobless claims pushing back against the gloom. Tech rallying, Tesla rallying after reporting better than expected results. And the White House slamming Chevron's $75 billion buyback. We begin with the big issue, the latest read on the U.S. economy.
We have seen very mixed signals.
This divergence between the forward-looking sentiment gauges.
Yes, there's been some weakness in the soft data in the U.S.
That's definitely visible in the manufacturing sector.
Like those ISM, like CEO confidence plummeting.
There is a slowing in the U.S. economy.
But we've yet to see that in the hard data.
Well, the hard data is looking good.
One has to contrast this with an extremely tight, a historically tight labor market.
But when we look at what's happening with the consumer, which is the backbone of the U.S. economy, we are seeing a clear loss of momentum.
Every piece of data comes in, it's gonna tell us part of the story.
Of course, the fourth quarter number does look pretty good.
This is not going to be an easy one for the Fed.
The bigger question is, are we able to maintain that momentum as we turn the calendar page?
Joining us to discuss is New Edge's Cameron Dawson and Samir Samana of Wells Fargo. Cameron, I want to go straight to you on this. This debate over whether we're about to enter a recession or not. How about those jobless claims?
It is just incredible that we're continuing to see such resilience and strength within the labor market, which just points to an economy that is more resilient than expectations and likely can continue to surprise to the upside in the first half of 2023. It's important to remember our comps are pretty easy from the first half of 22. That's where we had negative GDP prints. So what this means is that the economy is really not giving any reason to the Fed to cut interest rates in 2023, which just means that the Fed could likely be more hawkish than the market is expecting. And usually when the Fed is more hawkish than markets, you see weakness in equities and fixed income eventually.
I don't see that weakness this morning, not in equities. We're up 0.6% on the S&P, on the Nasdaq up by more than 1 full percentage point. Samir, you anticipate that this recession could be imminent. Now, the sub-50 PMIs say, let's go. You're right. I've got to say, when I look at what's happening with jobless claims, they say no chance, no way, not anytime soon.
Yeah, I mean, look, that's the typical disconnect between leading indicators like those, surveys, and then kind of the coincident, indicators like unemployment. I think people sometimes kind of get carried away too much with the payrolls numbers because, again, those will kind of, deteriorate in real time as, companies start to actually go through the process of laying off those folks. Michael McKee just talked about how, look, Google's not even going to lay off people until April, and they just gave them notice, right? So in about 4 months, that's when that data will show up in the jobless claims, right? So I think you have to follow layoffs, and I think those are up quite a bit year over year. I think the other tricky part too is, look, we need a recession, right? That's about the only way really to get inflation under control. So, a lot of people might be thinking about recession in kind of a negative way. We think it's one of the only few paths towards higher markets.
Samir, can we just pick up on the economic data? You mentioned that claims are a coincidental indicator. If I look at the PMI, it's been sub-50 since the end of last summer. I look at claims are falling, they're not climbing. What do you make of that? There's a disconnect there. What explains it?
I think the biggest thing is the participation rate, right? You're still continuing to lose people from the labor force. So I think companies are hoarding labor, but I think the tricky part now is as earnings expectations start to come down and companies are actually, finding themselves losing some momentum on the earnings side, I think that's when they will finally kind of relent and let people go and in the hopes that they can get them back probably later this year or early next year.
This is a real debate right now. Deutsche Bank's Biggie Chowder weighed in on some of this. He labelled this the recession being pushed out and the prospect that this equity market rallies even further. He said there are 3 well-known reasons: strong household corporate balance sheets, companies hesitant to fire soon after widespread difficulty in hiring, and excess savings accumulated around the pandemic. And then he said this, and I think this is a really important line: real household income, after falling for a year, has grown solidly for the last 5 months, supporting real private consumption, which has continued to grow within its pre-pandemic up channel. Cameron, can I get your thoughts on that?
Yeah, Yeah, I think this is the Neil Dutta effect. He's been talking about how real incomes have been accelerating, not decelerating, and you typically don't see that at the beginning or when you're going into a recession. And I think the real question is why we're starting to see some of this reacceleration. Of course, inflation is fading, but we have to note as well that financial conditions have been easing rather materially over the past couple of months. And maybe this is one of the reasons why we're starting to see this reacceleration in some parts of incomes. And financial conditions today are now easier on the Bloomberg index from where they were in March of 2022, which means that it's a big question of how much the Fed will push back against that financial conditions easing, mostly as we go into the Fed meeting next week.
Samir, what's the biggest challenge to that view?
I think the tricky part from here is, I do think you'll get probably a little bit of a tick up in long rates. I think with the Fed continuing to at least keep the optionality live with respect to additional rate hikes, the market pricing in something sub 5%. I think that's probably the biggest risk to markets is that long rates start to kind of tick back up. And, as we all know, that's what goes into a lot of cash flow and dividend discount models.
Got to stay on top of the price action this morning, about 25 minutes away from the opening bell in New York. Equities up by more than 1% on the Nasdaq. Tesla absolutely flying. The stock in the pre-market up by around about 10%. We'll pick up on that story around the opening bell. Off the back of the jobless claims data, the GDP data, upside surprise after upside surprise through much of this morning. Let's get to Mike McKee for more. Hey, Mike.
Hey, John. I think the numbers, at least from the jobless claims, are what sort of grabs everyone's attention today. 186,000 down from 192,000. But GDP is what people were waiting for in terms of the overall numbers, and it comes in better than expected at 2.9%. The price index, which I don't have up there, but people will be looking at 3.5%. The question there is, what's the December contribution? We get that tomorrow, so we'll be looking for that. The initial jobless claims numbers I gave you, durable goods orders, 5.6%, ex-transportation, 0.1%. That was a lot of this number was Boeing, and I had it backwards earlier because I thought it was Boeing having a bad quarter. Boeing actually had a very good quarter, non-defense aircraft up 115%. Capital goods, though, down 0.2%. That's business spending. And let's go to GDP. Here's what we saw in terms of contributions to GDP. Consumers still very strong, up 2.1%, and that added 1.4% to GDP growth. Business spending, though, 0.1% to growth. Businesses really dropped off here in the fourth quarter, and that may be a sign of nervousness about what's going to happen. Government spending was up, but not as much as people thought. Defense spending not as high as thought, replacing stuff that we sent to Ukraine. Trade was 0.6 contributor, stronger, and inventories went up. There was a thought that inventories might have fallen. So you can see the impact over the past year in terms of what contributed. Now, GDP, the trend has been reasonably strong here. We saw a couple of bad quarters in 2022 that were largely driven by trade and inventories. Now that those are out of the way, we are seeing growth for the year. The GDP was up by 2.1%. And after those two bad quarters, you'd think things would continue to be bad, but instead a rebound. So the question is, what happens going forward in 2023? The forecasts are not strong, John, but maybe we'll be surprised as we have been with claims.
Hey, Mike McKee, great work as always. I think we're all surprised by that. 186,000 on initial jobless claims. Cameron Dawson mentioned it. Renmax, Neil Dutta talking up the re-acceleration in this economy. Last week, Mohamed Al-Arian on this program saying the Fed should hike 50 basis points. He wrote about it this morning on Bloomberg Opinion. He said the following: while it is true that the Fed is walking through a dark room, it is also true that time is of the essence. The Fed does not have as much time as it wishes. It can maintain flexibility and regain some credibility with a larger than expected increase next week. Cameron, you mentioned the Fed next week. Can we pick up on that theme? Why not 50?
I think why not 50 is simply because they have messaged 25 so clearly in all the Fed speak leading up to it. But I think that you could make the argument that 50 would be appropriate simply because the way that the Fed is going to measure its success in this tightening cycle is essentially the time between their last hike and their first cut. And so getting these hikes in quickly really would get to the point where they think the policy would be restrictive enough to slow down growth. And the problem is it's just not showing up in the numbers yet. And we're starting to see something that could even back them into a corner even more, which is that gas prices are starting to climb again. They're up 12% over the last few weeks. That's the biggest increase since the peak in gas prices back in June. And that will feed into month-over-month inflation data. So as we look forward to January and February CPI data, we wouldn't be surprised to see that start to reaccelerate, which means that March is a very important meeting for the Fed because maybe they can't point to this deceleration inflation data like they've been pointing to recently.
Cameron, this is going to be a big problem potentially if it plays out that way. We heard from Neil Kashkari of the Minneapolis Federal Reserve at the start of this year in a blog post, and it's this quote from him that I don't think many people in this market buy into. He said, "The second step of our inflation fighting process, as I see it, will be pausing to let the tightening we have already done work its way through the economy. I have us pausing at 5.4%. Cameron, this market doesn't buy that, does it?
Absolutely not. And the market's pricing in 50 basis points of cuts into the back half of next year. So when the Fed is telling us, and they keep repeating this quote, history warns against cutting too soon, the market is trying to call the Fed's bluff. But we have to remember that the bond market has not been correct about the pace and the path of Fed hikes. If we go back to this time last year, for the February 2023 forecast for the Fed funds rate, the bond market thought it was going to be just 1%. Next week, it's going to be up to 4.75%. So the bond market has been off base. And I think the reality is that those rate cut bets that are priced into the back half of next year, as they get unwound, as the Fed sticks to its guns on wanting to keep rates higher for longer, likely could put upward pressure on yields that we have to think about as we move through the year.
There's another aspect of this rate cut debate that I think we need to talk about a little bit more, an extra dimension. We mentioned it a little bit earlier this morning on Bloomberg Surveillance. There is a question, Samir, as to why we would be pricing in rate cuts here. Are we pricing in rate cuts because we think there will be a soft landing that doesn't require higher rates? Or are we pricing in rate cuts because we think there's going to be a hard landing that requires looser policy? Which one is it?
Yeah, I mean, I think that, look, it's more history, which usually, by the time you've raised rates this much, something has broken. It's just this time around, to all the points that we've already made, right? Things are just much more resilient. So I think the market is kind of probably relying a little bit too much on history. This time around is a little bit different. We are emerging from a pandemic. You have a lot of consumers globally. I mean, look at the Chinese who are just now able to kind of go back out, that are kind of revenge spending or whatever you want to call it. So for all those different reasons, the Fed's just not going to break anything at around 5% on Fed funds. So it doesn't lay the groundwork for those quick rate cuts that the market expects. It's probably one of our key themes for this year is that the Fed will hold the line.
Samir, you are bearish on risk assets, aren't you?
In the first half we are, but we do think in the second half there will be enough progress on inflation that the Fed can start to consider rate cuts at the very, very tail end of 2023, and the equity market being kind of the forward-looking animal that it is, will start to kind of sniff those out in the second half.
Samir, what do you make of the price action year to date then? I know it's early days, it's only a couple of weeks, but what do you make of it?
We've really been chopping, since kind of June of last year. We've kind of been right around 4,000, give or take, 200 to 300 points. So, I don't really take anything away from it other than you've got these two, contradictory forces with the markets wanting to call a premature end to the bear market and the Fed saying, no, it's a precursor for inflation coming to where we need it to be.
We'll talk about those contradictions in just a moment. Samir Samana there and Cameron Dawson. Equities right now up by 0.6% on the S&P, about 17 minutes away from the opening bell. On the Nasdaq up by more than 1%. Here's a contradiction. Jobless claims, sub 190. Coming up, another wave of layoffs gripping corporate America.
You're seeing quite a lot of layoffs in the tech sector, the financial sector at the moment, which is a degree of right-sizing following a fairly artificial surge in 21-22.
And that conversation up next.
we're doing a very targeted restructuring. 9 months ago, of course, everyone was expecting a deep recession everywhere. Now I would rather call it a cautious optimism. Now, the environment, is not great out there. But again, technology, when you talk about process automation to offset inflationary pressure, supply chain resiliency, this is where we are super relevant, and this is why we are confident about the year to come.
Layoffs continuing to pile up in the tech space, this time IBM, SAP and Lam Research all joining the growing list of companies reducing headcount in an effort to rein in spending. Kaylee Lyons all over the story the last couple of months. Hey, Kaylee.
Hey, John. Yeah, it has been so often that I come on here and talk about a new company joining this list, which has gotten increasingly long. Just in the last 24 hours, as you say, 3 more being added to it. IBM is cutting about 1.5% of its workforce. That equates to about 3,900 jobs for Lam Research, which is, of course, a big maker of chip manufacturing equipment. It's cutting about 7% of its workforce, about 1,300 jobs. Then SAP, who we just heard from, is cutting about 3,000. That brings the total number of tech companies that have announced job cuts in 2023 to roughly 20, including Amazon, Alphabet, Microsoft, Salesforce, Spotify, a few in the crypto space as well. There are others too. Together this year, they have collectively announced nearly 60,000 layoffs already, and it is January 26, and that's on top of the nearly 100,000 job cuts announced by the sector in 2022, which was up 649% from the year prior. And as you say, John, all of this is an effort to rein in costs as their growth slows down, and the realization dawns that they overhired during the pandemic boom of the last several years. The question we've all been asking, and as you were talking about just moments ago, is when is this going to start showing up in the economic data, given 186,000 print on jobless claims and an unemployment rate currently at 3.5%, which has gone down over the last couple of months. But for certain tech-heavy areas like San Francisco, for example, we have started to see that unemployment rate locally tick up. And of course, these are freshly announced cuts. That means they haven't actually hit yet. We can expect that number will go higher, John.
It's a good point, Kaylee. Mike McKee was talking about that in the last hour as well. Kaylee Lyons there on the breakdown of jobs in big tech. I want to come back to you, Cameron, on this story. Can this happen? Can this take place in isolation? Can you get these big cuts in one industry without it bleeding out into the rest of the economy?
Well, I think what's dampening it right now is the fact that job openings remain so high. If we look at job openings, there's still about 3 million job openings higher than the pre-pandemic peak, which might be the reason why, if we're seeing layoffs today, folks are able to find new jobs rather quickly, and that is dampening then the impact into the broader numbers. But as you asked, the key question is contagion, because that's what we've typically seen in prior cycles. It starts in one area and then slowly spreads its way to the broader economy. So we'll have to watch it closely, but for now it's job openings that are keeping us from seeing it show up in initial claims.
Cameron, tech got hammered, absolutely hammered in the last 12 months. Year to date, though, anything but. The Nasdaq's up about 8% year to date. Right now, Nasdaq futures up by 1.2. What do you make of the rally in big tech so far this year?
Yeah, it's a last shall be first rally because it lagged so much in 2022. And we also saw really extreme outflows from tech ETFs going into the end of last year, which just sets us up for light positioning and low expectations, which can give you a relief rally. Now, the problem with tech overall is that from a technical standpoint, if we're looking at the charts, they remain in downtrends. And now a lot of these names are very overbought into downtrends, which is not a very good position to be in. So we're doubtful that this tech rally has a lot of legs further. It certainly has gotten closer back to trend after being oversold. But we think the liquidity environment, meaning the Fed remaining tight, not cutting interest rates, not flooding markets with liquidity, simply doesn't support a lot of relative multiple expansion for tech names that still are trading at a pretty big premium to the market. So we'd be cautious to chase.
Samir, is this just a relief rally?
You know, we like tech. We like tech. We like energy. We like healthcare. You know, we think this is the environment where you want to try and kind of go towards those areas where there's more durable demand, especially, again, if our base case is a recession. You know, that being said, you know, I think there are parts of, you know, the market that get lumped into tech. So consumer discretionary, right, where you've got electric, you know, and hybrid vehicles, where you've got e-commerce, comm services, right, search, you know, social media, et cetera, that gets lumped into tech sometimes. So, you know, we're playing tech proper versus comm services and consumer discretionary, which we think will be much more harder hit by a slowing consumer and that multiple re-rating.
Samir, why won't energy? Why won't that get hit?
So it probably does get hit from the standpoint of people will consume less, but we think we're in the early innings of a bull super cycle, and we don't want to get too cute with respect to timing. We think energy has proven itself over the last year or two as being one of those things that we just can't do without. And, I think it's been proven now that some of the greener efforts just aren't as reliable when kind of the rubber meets the road. And so we think you'll have fossil fuels be a very important piece of the energy infrastructure for some time to come.
And Cameron, final word on that. Do you agree?
Yeah, we think the reason you own energy in portfolios is a little bit different in 23 versus 22. 22 was all about pure upside, big earnings growth, and being very cheap in its valuation. In 23, it's all about a hedge. It's all about if we see oil prices rise, it likely means that we're going to see inflation reaccelerate, which could be bad for other parts of the portfolio. So we like energy as a hedge against that because it's one of the few sectors that would do well in that potential scenario.
Did well last year, that's for sure. To the both of you, thank you. Cameron Dawson there, Samir Samana. Just responding to the data we've had in the last 60 minutes or so. Jobless claims, 186,000 off the back of some of that. Equity futures right now up 0.75% on the S&P. On the Nasdaq up by 1.25%. Treasury yields at the front end, yields higher by 3 basis points on a 2-year to about 4.156%. Coming up, the morning calls, and later, Tesla providing some relief following a string of difficult months and disappointing results. That conversation still ahead with Pierre Ferro of New Street Research. Thursday morning, early days, but equities looking good here on the S&P, up 0.7%. On the Nasdaq, up by 1.2%. Let's get you some morning calls. First up, UBS downgrading Pfizer to neutral, $47 price target, seeing limited upside to the pipeline and overly optimistic profit estimates. That stock is down 1.6%. Your second call from Wells Fargo, downgrading Hyatt Hotels to equal weight, expecting the recent rally to start fading after jumping 25% this year. That stock's down 1.3%. And finally, Wolfe Research raising its Tesla price target to 185 after earnings, saying management provided encouraging messages on growth and margins. That stock is absolutely flying, up more than 10%. Coming up, we'll catch up with the bull. New Street's Pierre Ferro joins us at the opening bell with more on Tesla's post-earnings rally. That conversation just around the corner. 23 seconds away from the opening bell over in New York City. Check out the price action. A lift in this equity market, up 0.7% on the S&P. On the Nasdaq, absolutely flying year to date. The Nasdaq 100 year to date coming into today's session up by around about 8%. We're looking to add some weight to that at the open. The Nasdaq right now at 1.2%. There's your opening bell. Switch at the board and get to the bond market. Post GDP, post jobless claims, that claims number, just wow. To see jobless claims drop to 186,000 and push back against the gloom. Yields right now up 3 basis points on a 10-year, 347.44. Euro dollar a break of 109, just about 108.99, down to by about 0.2%, just about holding on to a 109 handle right now. Crude at the moment, positive 2.3%, $82 a barrel on WTI. At the open then, about 25 seconds into the session, equities positive across the board, up 0.7% on the S&P. Looking at the Nasdaq up by 1.3%. Tesla rising 11% at the opening bell. That's the stock to watch. Higher for a 5th consecutive session after reporting better than expected results. Elon Musk reassuring investors over demand, saying thus far in January, we've seen the strongest year-to-date orders ever in our history, almost twice the rate of production. Ed Ludlow on the West Coast following this one. Morning, Ed.
Yeah, good morning, Jonathan. Tesla at its highest level since December 13th. 5th straight day of gains, the longest streak since September of last year. And as you said, actually what's so interesting is that we're now 50% plus on Tesla higher from our January 6th low, which I find astonishing, the gains we've had in momentum on this stock in such a short space of time. Let's get straight to the numbers. On the bottom line, adjusted earnings per share of $1.19. That was on revenue of $24.3 billion, both above expectations. And as you said, there was fighting talk from Elon Musk and other management about the demand picture, although they did acknowledge that in 2022 at least, a lot of their issues, both on the production side and on the delivery side, were in China. They reiterated and continued to state this ongoing above 50% compound annual growth rate, which is compared with its 2020 base, and reset expectations for 1.8 million units in 2023. On the call, Elon Musk said that 2 million units was possible, which is more in line with what the street sees, at least the more bullish elements of the street. Some analysts out there this morning saying actually the 1.8 million guide is conservative. Elon Musk said on the call that they're not committing to 2 million. It's just that it's possible should there be no supply chain constraints and no headwinds. That said, he also talked about the economy and said that a deep recession, a potentially deep recession, is possible in 2023. You take that into account in the demand picture.
Stock is up more than 10%. Ed Ludlow, great work as always, buddy. Thank you. The stock looking to reclaim a $500 billion market cap. It's a very different story for IBM. Shares extending declines on a cash flow miss. This coming amid plans to cut nearly 4,000 jobs. Abby has more. Hey, Abby.
Hey, John. Yeah, well, the biggest headline here probably was about the job cuts, that familiar headline that you and Kaylee have been talking about so much, so frequently. 3,900 people worldwide were cut. Now, it does have to do with one particular unit. It's a little more than 1% of their global headcount. And in addition, they are actually continuing to hire in high growth areas. So there are two different ways to look at this layoff, maybe trimming again with relative to that one unit. Now, relative to the quarter, it's kind of interesting because I would say that the number that, or the word that describes it best, is flat. Relative to both the top and the bottom lines, if we flip up the board, we will see that numbers came in for both revenues and EPS just a little bit above what was expected. But that free cash flow miss that you were talking about, probably having to do with FX, it was a solid miss there. On the other hand, the 2023 free cash flow estimate is better than expected, or what they gave is better than expected. As for finally revenues, it's an interesting thing, John, because you wouldn't expect this for a stock that's down. They actually, in 2022, put up their best annual growth since 2011, 5.5%, 2 years of up growth. So who knows? Maybe this stock will pull something similar to a Microsoft, a Tesla, and some of the banks, where bad results, or even in this case, mixed results, will be looked at differently as the day goes on or in the days ahead.
For now, it's struggling. The stock's down by 3.7%. The broader market's still doing okay. 4 minutes into this, up 0.8% on the S&P. On the Nasdaq, up by 1.6%. We had earnings from a host of airlines through the morning. Southwest and American Airlines delivering a mixed outlook. Kaylee Lyons has more. Hey, Kaylee.
Yeah, and it wasn't just them either. You also had Alaska and JetBlue reporting. Alaska a little light, JetBlue beating a little bit. You do have a mixed bag when it comes to the stocks. The big outperformer, though, being American, which is up about 1% here in the first few minutes of trading. It was less about the quarter and really, for me, more about the forecast, because it kind of blew it out of the water. They expect earnings for the full year 2023 to be between $2.50 and $3.50 a share. Analysts were only looking for $1.89. So really just chalk that up to demand being strong, capacity being constrained, and that supply and demand dynamic equating to higher fares and higher profit. To give you a sense, in the fourth quarter, American's passenger yield was up 28% year on year. For Southwest, though, it is a less pleasant story. They had told us a loss was coming because of that holiday fiasco in which we saw the cancellation of nearly 17,000 flights, but the loss was wider than expected, 38 cents per share. Analysts were only looking for a loss of around 7 cents, and they're expecting a first quarter loss as well as the fallout from the episode extends. Southwest says revenue in the current period will be reduced by as much as $350 million through a combination of ongoing cancellations and reduced bookings. So a hit on the top line, plus they're expecting more cost pressure as well. Non-fuel costs, they say, will be up as much as 4% in the period. They do, though, see a light at the end of the tunnel. They said March bookings and fares appear strong, so they're encouraged by those trends. And again, that does come back to the idea of still strong demand for air travel. That has helped these stocks outperforming as well. Year to date, so in just a couple of weeks, the Super Composite Airlines Index is up about 20%, and that is well outperforming other stocks in the transport space, John.
The performance of those names has been unreal, unbelievable. Katie, thank you. Southwest this morning down a little more than 3%. Not a fun time this morning for Southwest investors. Not a fun time over the last month for people travelling with the airline. I want to turn back to Tesla. The stock flying. New Street's Pierre Faragoud doubling down on his high conviction call, maintaining his buy rating and a $320 price target after results, and saying the following: demand is not an issue. We expect unit costs to improve materially this year, driving margins back towards 25%. The stock has a very attractive valuation, offering more than 100% upside potential, and we see material further upside beyond. Pierre, I'm pleased to say, joined us now. Pierre, let's start there. You like what you see?
Yes, I like what I see. Absolutely. Can you imagine that Elon Musk stayed? They're booking 2 cars while they're producing only 1. And the big concern of investors that was completely understandable since September was like declining demand, getting a demand issue, price cuts, something like that. And basically what we see is that Tesla played the game of making very highly visible, very well, advertised, very significant price cuts. And that created like a boost in demand. And what we start seeing now is that Tesla is already starting to slowly increase some of the prices to keep things in check. So we have a very significant price cut. That's what Tesla needs to continue to grow. It's all about affordability. Tesla will be able to sell at some point between 10 and 20 million units a year if they can keep reducing the cost of their cars. They've taken a significant step towards that. And what we heard last night is that the whole thesis is still playing out well. So number one, demand is back stronger than you could ever imagine. And number two, Zach, the CFO, really had very interesting comments about where he sees gross margin and unit prices landing on the back of these price cuts. It's above 20% gross margins, and it's on an average selling price above $47,000. That was a huge reassurance for investors to hear that color last night.
Pierre, if demand is so good, why are they cutting prices?
Well, that's the whole thing. You don't want to forget the 2 parts of the story of Tesla. Tesla is meeting unlimited demand as long as they continue to make their cars more affordable. So to give you a sense for that, John, last year, Tesla was selling cars for an average selling price of like $55,000. At that kind of price point, you have like 7-8 million units as a market globally. If you want to sell 20 million cars, you can't stick to that price point. You have to lower your price, not because you have an issue, competition putting pressure on you, but just because you need to make your product more affordable to expand the addressable market. And so Tesla needs to do that. So Tesla has no demand issue, but part of the plan is to keep taking prices down progressively over time. It's very important. Remember Apple, 2007, the average selling price of an iPhone was, take it or leave it, about $800. 5 years down the line, 7 years down the line, the average selling price of an iPhone was like $550, maximum $600. Apple took the price of the iPhone down very significantly. What was the result of that? They took volumes from 10 million units to 230 million units. And in the process, they had to take gross margin down from high 40s to mid 30s as well. But that was a good move. Like moving from 10 million to 230 million units was a good move for Apple. So you have to think about Tesla as a technology product. And for a technology product, these price cuts made complete sense. It's very disturbing for people looking at the car industry, because the car industry has not been doing that for almost 100 years, like innovating at that pace. But for a high innovation product, it makes complete sense.
Pierre used that word tech, and I think that's a debate right now on Wall Street, how to value this company as a tech firm or as an automotive firm. And that brings up the multiple question. Can you run me through where that 100% upside line comes from? What are your earnings for next year, and what multiple is on them to give you that potential upside?
Yes, of course. Very happy to do that. So if you look at the stock today, today, maybe not today, but let's say more tomorrow, it was not trading even on 20 times the kind of earnings we expect for next year. So next year, we expect like $7.90 of earnings. We're slightly above expectations, but not significantly, like by maybe 10 or 20%, something like that. So we don't have like an out of common sense kind of expectations for next year. We just think Tesla keeps growing production, maintains gross margin in the 25% region, and mechanically we think they get there. And what we think is that, historically, Tesla has been trading between like 60 and 100 times earnings. These days are behind us. You know what happened last year, like the long duration growth names like Amazon, like Tesla, like Nvidia, and many others all have derated significantly. That's a reaction to increased interest rates. It changes the way you value long duration growth. But given this set of compares, we think a sustainable trading range for Tesla is going to be between 40 and 60 times earnings. And so what we're thinking is that by the end of this year, Tesla should get back to 40 times earnings. If they do say $7.90 next year, we have like a price target of $320. So it just still offers you 100% upside on where the stock is trading right now, as I see it on your screen.
That's constructive stuff. The stock's flying on my screen right now. It's up about 10%. Pierre, always great to catch up with you, sir. Hopefully we can do this next week and we'll talk about a different firm. We'll be talking about Apple this time next week. Pierre Ferro there covers both of those companies. Tesla up 10% in early trading about 12 minutes into this session. We're positive by 0.8% on the S&P, on the Nasdaq up by 1.3%. Coming up, the White House turning its attention to big oil.
House Republicans are using their narrow majority to force the American people to pay higher gas prices, just as big oil companies are amassing record profits.
We'll get the reaction down in Washington, D.C. and the case for cyclicals. That conversation up next with Barry Knapp of Ironsides Macro.
The president spent the last 2 years, as you know, doing everything he could to lower gas prices for American families. House Republicans are using their narrow majority to force the American people to pay higher gas prices, just as big oil companies are amassing record profits.
Chevron announcing a $75 billion buyback program and provoking fresh attacks from the Biden administration, demanding more supply to lower prices. The White House writing in a statement the following: for a company that claimed not too long ago that it was working hard to increase oil production, handing out $75 billion to execs and wealthy shareholders sure is an odd way to show it. Team coverage starts right now with Bloomberg's Kelly Lyons in New York and AMH down in D.C. Anne-Marie, the latest.
Well, it's a feisty response, to say the least, wasn't it, Jonathan, from the White House? But you shouldn't be surprised. The Biden administration has been scolding oil companies for months about higher dividends, about share buybacks. And what many in the White House, and also those on Capitol Hill on the Democrat side, is that they blame the oil companies for a rise in gasoline prices. And they say that oil companies are profiteering from Putin's invasion of Ukraine, which led to higher energy prices. So, Jonathan, this debate that's been going on between the oil patch and the Biden administration is not letting up.
Well, let's put a number on it. Katie Lyons, across the oil industry, that number's huge.
It is huge. I mean, let's just talk about the number of this buyback figure for Chevron. $75 billion is triple the previous authorization from back in 2019. It is 5 times the current annual level of buybacks, and it's equivalent to nearly a quarter of Chevron's market value. So this is huge. Plus, they're upping their dividend by about 6.3% as well. Obviously, all of this fueled by excess profit, which has been fueled by higher oil prices, which, yes, are off of the highs from 2022. WTI is down about 7.5% over the last year, while energy stocks are up 39%, because ultimately, John, this is not just about crude prices. It's about product, gasoline, diesel, and those refining margins. That is where the profit comes from. We'll get those fourth quarter profit figures from Chevron tomorrow morning. But when you add up the full year for Chevron and the other oil majors like Exxon and BP, Total, etc., we are expected to see $200 billion almost in profit in 2022. That is 50% higher than the previous annual record. And instead of taking that profit and in doing more capex, investing in production, as might be more politically popular, they're funneling most of it back to shareholders instead, John.
Kelly, thank you. Kelly Lyons and Anne-Marie. We always do this with the oil majors, but never with, say, Apple.
I knew you were going to say
Apple
that.
Last year was 89 billion.
89.
AMH, I know, unpredictable. It's just always the way. Always seems to be the way.
Well, Jonathan, every day Americans see the price of gasoline the same way they don't factor in the price of an iPhone maybe once a year or twice a year.
Sure, I guess that makes a difference. Anne-Marie down in DC alongside Kelly Lyons in New York. Barry Knapp of Ironside's making a case for cyclicals this year, writing the following: until technology and other related sectors are more reasonably valued, the opportunity is in economically sensitive cyclicals. If you position using individual equities, we would limit exposure to large caps. If you utilize ETFs, we prefer equal weighted. Barry Knapp joins us now for a few minutes on this. Barry, let's pick up there. The cyclicals, energy, does it make a difference what the White House has to say about it?
I think that the concept that's lost presumably on the White House and on a lot of investors with respect to energy is that what shale fundamentally did was remove the bust from boom bust and make the return on invested capital far more stable. Prior to shale, if they wanted to drill new wells in the Gulf, for example, that could take 3 years. And if you shut that well down, it's gone until you want to drill another one, which takes 3 years. Shale can be started and stopped in a 3-week period of time. So that makes their returns far more stable, which is really does set the stage for things like return of shareholder equity to shareholders, because they just aren't going to have those bust scenarios where if the price of oil were to collapse, then they'd be up the proverbial creek. So I think that's one of the things that's kind of lost on investors and clearly the White House as well. But
well, Barry, let's talk about the broader market and the broader economy. This is not lost on either of us right now. Jobless claims are exceptionally low, 186,000. I've got to say, Barry, I'm surprised. We've got all these rate cuts priced in. I'm looking at the bond market, and we don't seem to be seeing a vicious move off the back of this. Let's say I told you that claims would come in the way they're coming in over the last few weeks. The 2-year's still at 416. It's only up 4 basis points on a day, Barry. What do you make of that?
First of all, continuing claims have been rising fairly steadily. I know you guys had a conversation with Mike a little bit earlier about potential seasonal adjustment factors, but I think the right way to look at the labor market is the way Brainerd appears to be looking at it, which is if you look at total labor income, total hours worked times average hourly earnings, there's a real deceleration going on. Now, it hasn't resulted in significant layoffs via jobless claims as of yet, but that labor income was 10% nominal at the start of the third quarter, down to 6 and change by the end of the fourth quarter. So you either work people fewer hours and pay them less, right? Because average hourly earnings are coming down as well. So labor income really is slowing, and I think the market sees that. I would push back on the rate cuts later in the year because I think inflation is going to prove more intractable around 3% than the market expects. However, it's clear the labor market is clearly softening from the perspective that I just gave you, which is the broadest perspective.
Sure. So, Barry, where does that leave your call on treasuries going into next week for the Fed? Are you tempted to short them or stay away?
I am for sure. I mean, 10-year real rates at 125 basis points is only into the middle of the zone as to where they were throughout most of last business cycle when the Fed was accumulating treasuries. So, and break evens down at 2.25%, 2.3% on the 10-year part of the curve. That to me looks too low. So I think that fading the Fed, which is counterintuitive, right? Because I think we're looking at 25 and done. I don't even think we'll get a March hike because I expect the labor market to deteriorate further. But then I think that's going to cause the curve to steepen out, the back end to really underperform. And that to me would probably be a pretty good trade once we get that final maybe push higher in Treasury prices, lower in yields after the Fed meeting next week.
25 and done. There's a call from Barry Knapp of Ironsides. Barry, it's been too long. Let's catch up soon. 25 and done, the call coming from Barry for the Federal Reserve next week after seeing jobless claims come in sub 190, 186,000. Phenomenal stuff. This is going to be the conversation going into next week. What do you follow? What's happening with claims or what's happening with PMIs? Sub 50 claims in and around 190,000. Coming up, your trading diary. Equities up 0.4 on the S&P. Your trading diary's up next. 25 minutes in, equities flying. On the Nasdaq at least, year to date, we had some more weight to that rally, up 0.9% on the Nasdaq. On the S&P, up 0.33% on the S&P 500. Coming up, your trading diary, new home sales at the top of the hour. Look out for that data in just a moment. President Biden discussing the US economy from Virginia at 2:45 Eastern time. We get earnings from Intel and Visa after the closing bell, followed by results from Chevron on Friday. And finally, PCE numbers and the UMich sentiment survey to close out the week. That is all still to come from the City of London. That does it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.